Welcome back, cool cats. It's almost election time and we are jumping straight into the charts. We've had some more price action develop, and depending on where you initially measure from, whether from here or from here, we've actually got two different targets that SPY is going to be targeting into the next few weeks. And obviously the market could continue higher, but I think there is so much bearish structure overhead, it's actually very likely to head down. So what are we looking at? Our first target here is right around 545, which is actually confluent with the previous long running ascending channel, which you actually have to kind of zoom out to see, but you can see here, this ascending channel, we've been in and out of it, but that is the previous upper resistance line of that ascending channel. Now, the secondary target would be somewhere around 534 to 535, which is confluent with this previous demand zone. And don't forget the massive rising wedge pattern here that we've been covering now for months. If that breaks down and it fulfills its target, it's targeting somewhere around 510 to 512, a very sharp drop of about 13%, which also would have it falling right into this previous very strong demand zone. And if we take a look at the Ichimoku cloud on the weekly time frame, we could see that that's coming right down into this very, very strong support. It potentially could even come down to somewhere like 500 to 505 and then get a really strong bounce. Keep in mind that if this pattern target plays out, it'll place SPY below the 200-day simple moving average, which is potentially bearish enough to lead to a new bear market. As we've seen with previous bear markets, I could see an instance where we get below that, come back up and retest it, and then head lower. And one other thing I'm seeing on SPY is this hidden bullish divergence. We've made a lower low here, whereas we've made a higher low here on the actual chart. Typically what happens is you have a bounce up followed by a deeper pullback or sell-off. And we've got a lot more to cover, and I'm going to be explaining why I think it's much more likely that the market actually sells off right around election time rather than pumping right after it. And don't count QQQ out. When we take a look at it on the 1 hour, back on the 23rd, which was last Wednesday, when we had this big sell-off on the overall market, what happened is SPY broke below its main support line, and it broke all the way down here, and then the market hit this main support line on QQQ, pushing it back up. But as you can see, right as it got near to this main resistance line, the market started to sell off again. So if QQQ breaks this main support line somewhere around 490, we've got our first, second, and third targets roughly around 440. Then we've got 420, which actually happens to be a very strong demand zone. And then we could actually see this going all the way down to around 395, which if we look on the weekly is right near kind of a support zone, not a main one, but the main thing is it's right near this 100-week simple moving average. Now that last target would be roughly a 21% drop, also placing QQQ well below its 200 daily simple moving average. For the first time since we broke out above it back near the end of January of 2023, which we can see happen right here. We broke above, retested, and then it was off to the races. Now we can't mention a market sell-off without talking about the ticker that has been leading the entire market this whole time. NVDA is dangerously close to this very long-running resistance line. And it's one of those resistance lines that goes back so far, you really, really have to zoom out to even go back to where it starts, which goes all the way back to basically like the end of September, maybe early October of 2018. Now, if this resistance line holds up this time, we could see this massive rising wedge pattern finally play out. And if it does, that would be targeting right around like $70 a share. This is actually confluent. There is a daily gap here that went all the way back to February 21st of 2024 of 68.89. So potentially we could see NVIDIA fill that gap. Talk about a crash. And cool cats, remember, throughout the week, I do try to share market updates that I see in real time. Just like I shared on last Tuesday, QQQ into the close showed this obvious rising wedge pattern. Do you know how that played out? This right here. This is how it played out. We went from a high the previous day of around 497.50, hit bottom at right around 485 the following day. If anybody had caught that move and swung puts, I mean, these are the kind of moves that make your entire month. Again, this is not financial advice. So if these kind of market updates are something you're interested in getting, don't forget to subscribe and tap that notification bell so you won't miss those updates. While you're already down there, please tap the like button, for the algos. Up next, we're taking a look at IWM, which is for small cap companies. We've got multiple nested patterns. So first up, we're looking on the 15-minute time frame. I identified this rising wedge. One could potentially argue it looked more like an ascending triangle, but I think it was more of a rising wedge. And we can see that we had this initial false breakout that hit this kind of like short-term supply zone. For people that say that patterns don't work, a lot of times there are false initial breakouts, but then the patterns play out like to the T. And one of the reasons that I just love the Ichimoku cloud, especially when you're doing a multi-time frame analysis, is look at this on the 2-hour time frame. The Ichimoku cloud resistance, the main resistance was right here. So even if you hadn't charted previous support and resistance lines or supply and demand zones, you literally could have had this one indicator on your chart and seen that this is very likely the top before at the least a pullback was going to occur. But instead, as you can see, we hit it and then just shot down very sharply. Now, a lot of times what happens when you've got pattern breakouts is they'll try to retest previous support or previous resistance. So there's a possibility it comes back up here. This happened in after hours, but it was only on a 1-minute candle. So, I mean, it's a definite possibility that this comes back up and tries to retest previous support, maybe around 220 or 221. But even if it does that, if that acts as resistance, this pattern is actually targeting somewhere right around like 216. And if you thought we were done with Ichimoku, no, think again. That pattern target would have the IWM coming right into this main support part of the cloud. Now, the pattern I really want to show you, and we have to zoom out to the 4-hour time frame to even be visible, is this massive rising wedge pattern on the IWM, which is confluent with what we're seeing on SPY and QQQ. When we take a measured move from the beginning, we can see this is targeting about a 22-point sell-off, or roughly about a 10% sell-off. If we were to make the assumption that this is going to start its sell-off somewhere around like election day or maybe somewhere after, we could see it go down through this demand zone and target somewhere around 195. Now, it really depends on where this is going to break some. So my guess would be between 195 to 200, depending on where it breaks support. Now, you've seen me use it on my channel a few times before, but the TTM squeeze indicator actually utilizes the Bollinger Bands here in blue and the Keltner channels here in purple. And anytime you have the Bollinger Bands, which measures standard deviations, gets inside of the Keltner channels, which measures ATR, we could go over that on some other video if somebody's interested in that. Whenever we have a squeeze in volatility, what happens is you typically have a very explosive move that follows that. And so when we look at the Bollinger Bands here in blue, we can see that we've had an increase in contraction, and now we're getting an expansion. And since resistance held up here, it seems that this really has nowhere to go but down. And I mentioned this demand zone a second ago. You really have to go way back to just see where it's coming from. But you can see anytime we were above it and we came down, it acted as support. If we were underneath it, it acted as resistance. So if this gets broken, IWM could become very, very bearish at that point. But again, it would have confluence with meeting basically the 100-week simple moving average here in blue. And it would be well below the 200-day simple moving average. Very, very bearish signs. All right, so we're transitioning into Dixie, the dollar strength index. You can see we've had this well-defined channel. We broke briefly above it, then below only shortly because we have this seriously strong key level here. If we're above it, it's acting as support. If we're below it, it's acting as resistance. So the second we broke this channel, we hit in this support area and then bounce back up. And just to show you, this key level is right around 103.80. It's not 104 exactly. But one thing that I did notice, we look at the RSI here versus the actual chart of the Dixie. We have hidden bullish divergence forming here. This made a lower low. This made a higher low. As I like to say, a lot of times what we get is one last impulsive push to the upside, followed by a very sharp move to the downside. And of course, if we zoom out to the daily, we can even see we had bearish divergence right here. We made a lower high on the RSI, whereas here we obviously made a higher high on the overall charts. Then we had that hidden bullish divergence. We're going to probably see this push a little bit higher at the least before it breaks this upward channel. Now, my first target here would be around 104.70 because that is kind of a key level. However, I think Dixie could actually come all the way back up and hit this main previous resistance line. You can see how far back this goes. It goes all the way back to October of 2023. If it hits that line somewhere around 105.50, it could start selling off very sharply. And here's the interesting part. On the Thinkorswim platform, wherever you hover your cursor, you can see the date that shows right up here. When I hover, look what date this is targeting. The 4th or the 5th, right before or right after election day, somewhere around in that time, we could potentially see the dollar start to sell off. Now, could it break this resistance? It absolutely could, but this is a very strong resistance line. And I also find it interesting because the dollar can be seen as a safe haven asset. So people like move into cash during times of uncertainty. What's more uncertain than going into elections? At the same time where there's all these different talks of WAR and everything else. Surely we can't talk about Dixie without talking about TLT for long bonds. As you can see, it broke below this main support line, this long-running support line in yellow. But actually on the weekly, it kept from going below this main support line here in purple. You can see it wicked below, but it closed above. Sort of wedged between this previous support, now seemingly acting as resistance, and this previous resistance now acting as support. You got to zoom out a little bit to see it, but you can see where this previous resistance line is coming from. And if you haven't seen it yet, we do have a falling wedge pattern, which at the point where it finally reaches its apex, the weekly RSI is likely to be in oversold condition as well. So we have this falling wedge pattern right here in blue, in light blue, that would be targeting at least a 3-point move to the upside from wherever it breaks out. And I don't know anybody else that does this, but you can actually chart on the options charts as well. This is the option chart for TLT 100 call, the LEAPS option that's expiring in January of 2026. This falling wedge seems to be indicating that it wants to break out within the next day or so. However, when we take a look at the actual chart of TLT, the apex of this falling wedge is targeting around 89.70 to 90, which is obviously a very strong psychological level, and it would hit this support. Look up here again, look right there. It's going to hit that support right on or around election day. Now tell me that isn't a little bit spooky. When we throw up the Bollinger Bands and the Keltner channels again, we can see again, volatility is contracting on TLT. It is wanting to break out. There is the possibility that it uses this previous resistance line as support and breaks out within a few days. However, I am trying to line this up with what we're seeing on Dixie as well. And I'm not going to lie, I'm seriously contemplating going long TLT again near that support. In my opinion, the market keeps pumping because it's pricing in inflation caused by the irresponsible spending by our government. But if they decide to turn off the money printer right after the election, it truly could be like pulling the plug on the bull party. It's a legitimate question whether or not the election is going to be a sell the news event. So taking a look at investing.com's economic calendar, the real key catalysts that are coming out this week are going to be on Thursday and Friday. But on Tuesday, we do have the JOLTS job openings as well as CB consumer confidence. Those could potentially be market moving. And on Wednesday, we've got German GDP coming out. I know you're like, oh, it's Germany. It has nothing to do with us. But anything that affects the dollar, and Germany really is kind of the powerhouse over in the Eurozone. Anything that affects the dollar can affect the markets. And we've also got ADP non-farm employment coming out and US GDP. And as we come on down here on Thursday, we've got the Eurozone CPI. Again, this could potentially affect the dollar strength. And then the Fed's preferred inflation gauge, the core PCE month over month and year over year coming out on Thursday. We've got initial jobless claims. I mean, if that came out really bad, obviously that could affect the markets. And then, of course, on November 1st, Friday, we've got non-farm payrolls coming out. That tends to be a pretty decent market mover. If the unemployment rate comes out higher than expected, I think the markets could potentially go red as well. And I don't pay as much attention to them, but there are these manufacturing PMIs and prices and all that. These are things that some people do look at. And last but not least, taking a look at Moomoo's earnings calendar. We're very earnings heavy this week. So on Monday, we got Ford coming out after the bell. We've got Google coming out after the bell as well. Visa, AMD, McDonald's, kind of wondering about that one. And on Wednesday, we got Microsoft and Meta both coming out with earnings after the bell. We got Eli Lilly, Caterpillar. On Thursday, we've got Apple and Amazon both coming out after the bell. MasterCard, Shell, Uber. Then by Friday, everything's pretty much wound down. Then we've got some oil and gas producers like Exxon and Chevron. As always, nothing I share is financial advice, and you should always consult a financial advisor before making any financial decisions. I'm about to share this week's trading rule to live by, but before then, I want to say best of luck, cool cats, God bless, and stay safe.